Okay, welcome to Sacred Account Saturday. My name is Jerry Fetta. I'm the owner, founder, and CEO of the brand Wealth Dynamics. And I'm coming to you live today or on replay if you're watching on YouTube or you're listening back on our podcast to talk about the Sacred Account. This is what these Saturday classes are about. If you didn't notice, it's called Sacred Account Saturday. So that really is the focus of everything we discuss on these. But I want to just give you guys a little bit of background about why we do these courses and what the purpose of it is, right? And the reason that that's important to me is because it's very hard to learn about anything if we don't have a reason to, right? If I don't have a purpose for learning, I'm not gonna stick through it. I'm not gonna apply the information, and I'm really not gonna be able to get educated. Okay, growing up in school, that was always my issue, is I didn't know why I was there. Okay, I didn't understand, like, why do I need to know what the inside of a frog looks like? Right? Why do I need to know how to measure the angle of an octagon? Right? I didn't know those. There's no one ever sat me down and said, "Hey, here's why you need to know this. Here's where you're going to use it." So I want to give you that first before we dive into this today. Okay, so check this out, and we can all agree with this. Almost everything in life requires money. Okay, if I want to have a roof over my head, that requires money. Right? If I want to get transportation, that requires money. If I want to eat, that requires money. Right? If I want to have a cell phone, that requires money. Everything requires money. And it's to the point where it's right up there in life with things like gravity and oxygen, where it's just part of what we're born into. Right? No one ever says, hey, breathing is optional. It's like you better learn how to breathe fast, otherwise you're just not going to make it. Right? And if you have trouble with it, right, we have doctors, we've got asthma stuff, we've got sleep apnea things, like all this stuff to help us make sure we can breathe, right? And if you're not able to eat, right, like we've got supplements and all these things to help handle it, but nobody ever sits us down and says money is like that, and you need to learn how money works, and you need to be able to win with it, and if you can't, you're just not going to make it in life. No one had that conversation with me. So as a kid, my backstory, I'm 30 years old. I built a multi-million-dollar business. I've gained a multi-million-dollar net worth. I've built it up to the top, lost it, and rebuilding it again, right? And these are things that I had to learn the hard way in life about money, because I grew up poor, right? I grew up in a family where my mom and dad had, a bunch of kids. They lived on less than $30,000 a year in income. We went to food banks when I was 8 years old, all in the same summer, right? My parents get divorced. Our house gets taken away, the car gets repoed, and I'm homeless on both my mom's side and my dad's side, because now I'm splitting time between the two, right? And all of that had to do with money. And so I grew up in a world where I didn't know about money. Okay, I didn't know anyone successful with finances. I didn't even have someone I could look at it and be like, that person is doing well, right? What are they doing? I didn't even have that. So when I started to learn about finances, and I realized that all of these problems and pain in my life came from not knowing about money, and it could have been easily solved just by having the truth, having true, simple, and applicable information about money, right? I didn't need, $1 million, lottery ticket. I didn't need, have this great inheritance. I didn't need, a handout. I needed education. I needed someone that knew what they were talking about to sit down and say, look, here's everything that you should have learned. Right? Because we go to school so we can get good grades, so that we can graduate, so that we can go to college, so that we can get more good grades, so we can get our college degree, so that we can get a good career. And the reason we want to get a good career is why? So we can earn good money. So the whole point of everything we do, from the age of like 5 to the age of like maybe 22 to 23, maybe 25 years old, is all revolving around getting money. And then we're never taught, what is it? How does it work? What should we do with it once we get it? And then we wonder why people struggle so badly in life, right? We live in the wealthiest country in the world. And we've got some of the highest consumer debt, some of the lowest savings rates, right? Like there's countries in Europe where the saving rate's higher than what we save here in the United States of America, and they pay higher taxes, and they earn less income, but they're kicking our butts on saving money. Right? And saving money is not hard, right? It's literally earn more than you spend. So I do these courses because this is stuff we should have learned in school and didn't. And so I've been doing the course every week for the last 4 or 5 years in a row now, no fail, for free, because it's education that needs to be out there. Okay, and you can see, like, all of the things that someone could be doing on a Saturday. What brought you here? Right? Why did you take time out of your weekend when you could be relaxing? You could be watching Netflix. You could be out with the family. You could be, just having a good time and loafing. And instead you said, no, I'm going to come here today. I'm going to learn about money. For me, that tells me two things. It tells me that you're serious about your financial future, right? And it tells me that you're willing to invest in improving yourself. And those are two of the best qualities that anyone could ever have, is being serious about their future and being willing to invest and do something about it. Right? Think about just how much money does it take to go to college? If you look at the average college tuition right now, people are going into massive student loan debt up into the six figures. I've had clients that come to me and they say, hey, I've got, $200,000-$300,000 in student loans and I don't know what to do with it. Right? Did you know that when you go to college, there's a 52% chance that you will not get a career in your degree field after you graduate? Think about that. That means that if you did a coin flip, it's more likely than not that you're going to end up in something other than what you studied. Right? You're less likely to get something in your career path. But how much do we spend on that? How much do we spend on that experience? We spend tens of thousands of dollars and hundreds of thousands of dollars for a 50-50 chance that we might get what we bought. We might get the thing we paid for. Right? I never liked that. So finances, guys, are something where you're dealing, if you do it correctly, you're dealing in certainties. I don't like dealing in uncertainties. I don't like dealing in the hypotheticals and the maybes. That's one of the reasons I don't do the stock market. I don't want to maybe make money. I don't want to ask a question like, what can I expect? And someone's like, well, I can't tell you. Right? Like, that's not the experience that I want. Right? Finances come down to math and vocabulary. And the math isn't even hard. You don't need to know calculus and trigonometry. You need to know basic algebra. Add, subtract, multiply, divide. If you can do that, you can do anything you want with finances. Right? And you don't even need to know how to do that. You just need to know how to use a calculator. Right? Same thing with the vocabulary. You don't need to know all of the words. You just need to know how to look them up. Right? Like, we're in a day and age, like, if you guys thought Google was cool, we have artificial intelligence now. Anything you want to know, you can go on Chat GPT, artificial intelligence, ask the AI, and pretty much it's going to give you the right answer. Right? Like, within a pretty close proximity. I'm not saying go get all your financial advice from an AI, but I'm saying now there's no excuse not to know something. Right? If I don't know about money, I'm going to quote Bill Gates here. If you're not wealthy, if you're born poor, he says, if you're born poor, that's not your fault. But if you were born poor and stayed that way, that is your fault. Fault being responsibility. Okay, finances are personal. It's actually a scoreboard for how right my decisions are. The more right my decisions are, the more income I'm going to earn, the more money I'm going to have saved, the more money I'm going to invest, the less debt I'm going to have, the more passive income I'm going to have, the higher my credit score will be, the less I'll pay in taxes. Right? The less right I am, I'm going to have a lower income. I'm going to not be saving. I'm going to be struggling. I'm going to have debt. I'm going to overpay in taxes. Okay, and right is a indication of the validity of the knowledge we operate with. So I teach these courses to give you the information I got. Because there were a few times in my life where someone that was more financially successful than me was willing to sit down with an 18, 19-year-old kid and say, look, I'm going to teach you something basic here so that you can do better in life. And if it hadn't been for those free conversations, that spark for me never would have been ignited. And I would have never said, I want more of this and I'm going to go spend the rest of my time, because it wasn't the entire time that I was given information. I was given just enough to see that there's something else out there. The rest was up to me. I had to then go find the books, the courses, the material, right? The experts to go learn from. And that took years for me. That was, I started doing this at 18. I'm 30 now. Right? It took me that long to get all of the information, understand it, use it, organize it to the point where I can actually teach it to other people and share it with them now. Right? And I don't want it to take 12 years for you. And this is why I do these courses. And you're not going to learn everything on today's course. Today's course is to do just that, to give you just enough so that you see there's something else out there. There's a better way. Right? And when you see there's a better way, then you're going to say, okay, good. I want to go then, on my own self-determinism, invest time, invest money, invest effort and energy in learning the other side of things, learning how to be financially successful, and not learning it, from me. Even the stuff I'm teaching you guys, I got from old, dead, wealthy families, individuals, entrepreneurs, business owners. They're old, dead, and wealthy and successful. Okay. And the stuff that we teach, it's been around for, hundreds and hundreds of years, in some cases, thousands of years. It's going to be something that's going to be around for hundreds and thousands of years still. And it just works, right? So I want to lead off with that. Now, before we get started in today's lesson, the thing I want to impart to you is first what the topic will be. We're going to be talking about how do you get more money to fund your banking system. Okay. In our worlds, we fund everyone else's banking system, right? We were taught, you can open up your own bank account. You can save in the bank. You could even rob the bank. No one ever taught me, Jerry, you can be the bank. Nor did they show me why I would want to, because I didn't understand what was happening with the banking system. I didn't know what banks do. And when I learned that, I was like, yeah, I want to be the bank. And so one of the things I'm going to share with you today is how do you be the bank in your own life? How do you stop giving money to other financial institutions so you can keep that and you can play the same game they're already playing? Here's the thing. It's already happening to your dollars. The stuff I'm going to teach you today, it's already happening to your dollars. It's just not happening to your benefit. All of the systems I'm going to show you today already occur with the money that you earn and save. So we're just saying, okay, it's already happening. Why don't you have the benefit? Why don't you do this for yourself? Other people are doing it with your money for their benefit. Okay, so a couple of ground rules. First things first, I want you to have your reason for being here. What's your purpose? Again, nobody does anything for no reason. You're here on a Saturday afternoon at 1 p.m. when you could be doing other things. Why is that? What made you come here today? Right, and I want you to have that reason top of mind. Second thing is, okay, I want you to get rid of the idea that money is complicated. Money is not complicated. I'm not going to beat this horse too much longer. Like I said, it comes down to basic math and vocabulary, both of which you can have on a smartphone, a dictionary, and a calculator. And you can learn anything you want to learn about money. Okay, proof of that. I was a C average student that grew up in Alaska. Okay, I grew up poor. I had no financial examples. I did not inherit a bunch of money. I didn't have anything that made me more advantaged than the next person. Okay, for those of you that have never been to Alaska, it's basically America's Russia. Like it's way the hell up there and it's pretty detached and isolated. So, when things happen down in America, as we used to call it, it usually occurred 3 or 4 years later in Alaska. So we were behind the times on everything, right? Like in high school and middle school, stuff that I thought was cool then is stuff people were doing when they were in like 4th grade down here in the US. Right? Even though Alaska is part of the US, but we refer to it as that because we were so detached up there, right? So the advantage thing is not really a card to play on this. Okay, the thing that made me successful with finances was really realizing that I could be. Getting rid of the myth that it's for those that are sophisticated. Because here's the thing, guys, is I went through and I studied the state exams and the federal exams, and I got licensed and I worked with Dave Ramsey and Grant Cardone and Pamela Yellen and a lot of these big names. And I realized that most of the stuff that I thought was fancy and important and sophisticated didn't actually apply. Right? It was interesting. I can tell you all these really big words I learned, but they're not actually things that apply in the financial world. Right? And so when you remove the idea that you need to be a certified financial planner or a CPA or a financial advisor, and you realize anybody that can do basic math and use a dictionary can learn about money, it opens up the world because now I can learn, and I'm not going to learn about something I don't think I can learn about. And that's part of the myth, and that's part of the trap here is the financial institutions have marketed to you that you need them. And the way they do that is they make you feel like you're inept at the subject, like you're unintelligent, you don't know, and so that's why I've got to hire someone else. Okay, what I'm doing is I'm actually giving up the ability to ever get the knowledge because I'm like, oh, that's that guy's job. Right? That's their job, not my job. I don't need to learn about this anymore. Okay, so remove the idea I can't learn about money. The second one is remove the idea that you know it all already. Okay, nobody knows everything. Usually the dumbest people are the ones that do think they know everything because they're not open to like learning new things. And when you're not open to learning new things, life is hard. My dad had a quote that he used to tell me when I was little, and I still live by it today. He said, life is hard, but it's harder when you're stupid. Right? Like just think about that. Like if you can just, look through the simplicity, it's true. Life already is hard. Okay. And not having knowledge, that would be stupidity, is the lack of knowledge or the unknowingness of thought, right? Like not having thought or being aware of it. Okay. That's what stupidity would be. And it is harder unnecessarily when I don't have it, when I don't have the knowledge, when I don't have the intelligence. And again, it comes down to learning it. Right? So knowing it all, I've seen this before, I've heard this before. To me, that's like when I was a personal trainer for clients, like, I already went to the gym once. Cool, but do you go every day? Okay, we have a program called Wealth Dynamics University where we have literally hundreds of hours of financial content. Okay, and it's going to keep you busy for probably the good part of a year if you were to go through all of it on a daily basis. We continue adding more to it. And it's the equivalent of if I heard a client tell me, oh, I trained once. Cool, but do you do it every day? Right? Like I was watching a video today on Kobe Bryant, one of the best, not only one of the best athletes ever, but one of the most successful people ever. I look at people that they're the top 1% of their craft, and I look at what did they do, and he practiced every day. Even when he was the best in the world, he practiced every day. The process of losing and winning with finances looks exactly the same if you're being successful. It's train every day. Do stuff to increase my income, set money aside in my sacred accounts, look at my transactions, right? Like I'm looking and we're playing what we call the 1 to 5 game where I'm rating those things. And if I'm doing that every day, whether I'm winning or losing, that's the habit and the behavior. It doesn't look any different. And so this idea of I did this already, I heard this already, I've seen this already, it actually flies in the face of everything it takes to be successful. Repetition is the key. Okay, doing the boring work over and over and over until you get great. And that applies to finances too. So remove that idea of I've heard this, I've seen this, I know this. Okay. And a lot of what we know is actually what is called a fixed idea. They're things we got from other people or other sources that we never really checked out and inspected to ask, where did this come from and is it valid? And information is only valid to the degree that I get successful results with it. So it doesn't matter how right the thing sounds or who I heard it from. If I'm not winning with the information, it's not true. Right? Like if I'm failing with it, then it's not correct. It's not something that actually works. Right? Now, I do want to keep this open as well. If you guys have questions, drop those in the chat. If we've got time, I tend to like to mic up and talk with you guys live. I don't get to talk with everyone, although I did send out about 115 text messages today to current clients just to check in. So I try to when I can. This is an excellent time to be able to talk with me, right? So if you have any questions, drop those in the chat. A couple of other things I want to go over. So as you're on the call today, you're going to get a message from Jules Allender on my team. So Jules is a senior wealth mentor. She's one of my endorsed wealth mentors with Wealth Dynamics. And so she's going to be reaching out to you in the chat today, whether you're new or whether you're an existing client. And the purpose of her reaching out is to help you. Right. So if you're, watching this for the first time and you've never seen any of our stuff, or maybe you have and you've never really taken action yet, and you're like, I want to learn more, but I don't want a sales pitch. I don't want the pressure. I just want to learn. I want to figure out, can this help me? Set up a free call today with Julia. Okay. Julia is going to answer your questions. She's going to be able to do that in a way that, helps you understand, can this help me? Do I want to go forward with this? And if you do, then our whole team is here to support you. Okay, Jules is an endorsed wealth mentor. An endorsed wealth mentor is somebody that they represent Wealth Dynamics as a brand. They've earned my endorsement. I've trained them personally. The experience you're going to get with them is the same experience you'd be getting with me if you're meeting with me one-on-one. And they're going to help you and they're going to mentor you. And they're going to mentor you through our programs, through the blueprint, and you're going to have that one-on-one relationship. Okay, everyone needs a good coach. Everyone needs a good mentor. Everyone needs that somebody that's there no matter what. Right. And so that's what Jules is for you if you're a new client, and if you're an existing client, especially too. Okay. If you're like, yeah, I just, I'm rolling, I'm doing well on my services, things are going great, I still want to connect you with Jules. Okay. Jules actually, and she might not tell you this about herself. Jules was a Division I college athlete, which just, if you can think with sports, just getting to that is almost impossible. Like that's a huge accomplishment. She's a renowned coach. She's coached, basketball on the West Coast and has a very strong record with doing so. And so when you're working with Jules, you're not just working with someone, you're working with a great coach. You're working with someone that walks the walk. She's a client. She's doing this stuff herself. She's coached athletes to success her entire career. She's coached herself to success, and now she's coaching clients to success with us. Right. So if you're a client, reach out to her. That call is going to be so valuable. Right. And so, check your chat. I'll remind you throughout today, check your chat. If Julie reached out to you, make sure you do connect with her. And I might even pick on you one-on-one if she lets me know, hey, I reached out to so-and-so. Can you give them a nudge? I might just, give you a nudge on the call here and let you know to respond back to her. Final thing is, if you have not gotten a copy of my book, okay, this is called Blueprints of Financial Freedom. Everything we're going to cover today is in this book. Okay, it's all from this book. Now, we're not going to cover it all today, right? We're going to cover enough to show you that there's solutions out there. There's things that maybe you didn't know existed and hadn't considered out there, and this book is going to give you the rest. Okay, so I want to give you a free copy of this book. It's jerryfetta.com/B2F promo. And you can get a free copy of the book. Okay, we'll cover the book. You cover your own shipping. We'll send it out to you. And that's going to give you the education, right? Now, here's my rule that I have for clients. I want you to be a reader. Okay, like thinking I'm going to become a millionaire and achieve financial independence and do it without ever having studied anything is nonsense. There's so much studying you need to be doing. And it's all like interesting stuff that works, and it's for your own benefit, right? So I like starting people with the book. Okay, get the book, go to the website now, grab it. You cover the shipping, we'll pay for the book. Don't worry about that part. We want to get it in your hands. Start reading it, start working with Jules, do some one-on-ones with her, and she's going to walk you through everything you're reading in the book. You're going to have a one-on-one coach on how to get from A to B. Right? So again, go to jerryfetta.com/B2F promo, and you can grab that there. Right? Now, I want to jump into what is the sacred account. Right? And the sacred account is such an important thing to go over because it's the basis of everything that we do, right? And I'm actually going to use a new presentation here that we've come up with. Let me grab it so that we can cover this together today. And I'm going to give you some really good math on what the sacred account is, how it works, right? And then really, like I talked about earlier, is how can you put more money in it, right? We want to be able to put as much money in it as we can, because right now we're probably putting our money with other people, right? We're putting our money in someone else's bank, right? And that's not serving us well. So the sacred account, what is this? This is high early cash value dividend paying whole life insurance. Okay. Now that's a mouthful. And the reason we call it the sacred account is I don't want to have to say high early cash value dividend paying whole life insurance every single time I talk to someone, right? Just with how fast I can say that, that tells you how many times I've said it, right? To try and say it 10 times fast. I've said it 10 times fast for years now, right? So the sacred account, it's a concept. Okay. The sacred account is an idea of being your own bank, right? The top 1% of wealth, guess how much they save on average? 40% of their gross income, 40%. Okay, that's an incredible amount of money. Now, the reason they do that is, you know, some of the stuff I'm going to show you today, but also the reason they do it is they have a purpose behind it, right? Why would someone, like, think of, I mentioned Kobe Bryant, for example. This guy would practice 5-6 hours a day. Why would someone practice a basketball 5 to 6 hours a day? You know, obviously they know what to do when they get there, right? They have a lineup of here's my activities, here's what I'm gonna do, but they have a goal. They know why they're practicing. Similar, why would someone save 40% of their income? Well, obviously they know what to do and where to put it, but they have a reason why. It's getting them to their goals. Okay, now I'm gonna start this out by giving you one tip. We hear about being in the top 1% of wealth, right? So to be in the top 1% of wealth, your net worth needs to be about $10 million. Okay, your income needs to be, I think, $500,000-$600,000 a year, right? And so for some of us, we might be close to that. We're actually like ahead of the game. For whatever reason, we're like, yeah, that's not that far off. For others, like the way I started, I was like, you know, I don't think I'm ever going to get there. I don't think that's possible, right? Like growing up in a household with my mom and dad where we made less than $30,000 a year, to hear if I wanted to be in the 1%, I had to make $500,000. I was like, that's unfathomable to me. Like I didn't know how to get there. And so these are called a lagging indicator. The income, the net worth, these are all things that you'll be in the top 1% of these last. That's the last statistic of yours that's going to reach top 1%. Okay, but there's also something called a leading indicator. Okay, a leading indicator means it's causative. If I do this, then those things will happen. You can be in the top 1% of wealth by savings rate. If you can save 40% of your income, you're now in the top 1% of savers, right? Logic stands to reason. If I'm in the top 1% of savers first, then soon I'll be in the top 1% of investing. And then soon I'll be in the top 1% of income and net worth, and those other statistics will follow, right? So I want to help you get first in the top 1% of saving. because they do save 40% of their income. Historically, that's what's happened, right? Now, what is the sacred account? This is a whole life insurance policy. I want to be very upfront with that, right? Now, this is not the kind Dave Ramsey talks about. This is not, the kind your brother-in-law sells. This is not the kind your buddy that just joined that network marketing company is trying to get you to sign up for. It's none of that, right? So this is a very specific kind. And the reason why the name is so long is because it's so specific. Okay, within life insurance, there's like the whole sea of life insurance. Within that, there's one specific kind called whole life. Whole life insurance means that you have a level coverage, like level death benefit, your premium stays level, and then you have a cash savings, and you can actually grow your cash savings account by putting money into it. Now, within the whole life insurance realm, there's a specific kind of whole life insurance called mutual, meaning the company treats their policyholders like a shareholder, and they actually will share the profit with you because you're like an equity owner in the company. Now, within that special type of insurance company called mutual, there's a specific design called high early cash value, right? So do you see, if we looked at this like a Google Earth, like we have the whole planet, and then we just zoomed into a country, and then we zoomed into a state, and then we zoomed into a city, and I'm telling you, no, we're zooming now in not to just the zip code, that specific house. And so if you give the address of that house, of course, it's going to have a longer name than Florida. Right? If you're like, I live on, my when I was a kid, right? I think my address was like something Erickson Road, Helena, Montana. Right? The name of that is longer than just saying I'm from Montana. That's why the name is so long. So this is a whole life insurance policy. It pays out a tax-free death benefit. It has a tax-free savings account, and it's over 170 years old. Okay, this is older than your mutual funds. Okay, this is older than your 401k. Did you know the 401k has only been around since 1980? It's not even as old as your parents. Like, we still don't even know what happens with the 401k. We've never seen a full generation of people successfully retire on it yet. Doesn't that worry you a bit? Like, we're being promoted, put all your money into the system, and we don't even know what happens. Right? It's kind of like, taking a new medication where they're like, oh, it's cool, it's safe. And then it's like generations down the road, people have 3 eyeballs and stuff because they took this stuff. We don't know what's going to happen. Okay, with the sacred account, we do know what's going to happen. It's over 170 years old. Not only that, it grows at a 3 to 5% tax-free rate. It has guaranteed growth and guaranteed loss, but even better than the guarantee is the track record. The guarantee is only as good as the guarantor. The companies we work with, they have never lost money, and they have only made money for 150 to 200 years in a row. Meaning they went through, some of them, the Civil War. Like, do you remember when the country almost split up into 2? Okay, we have companies that were around during that, and they were still profitable, and they still paid dividends to their shareholders, right? You remember the thing called the Great Depression? Okay, everyone lost money except for the insurance companies. They didn't. They were still profitable. They did not lose their policyholders' money. They still paid dividends. The 1950s recession, the 1980s recession, the tech bubble, the mortgage crisis, the pandemic, right? These are all times when people still made money, right? So it's never lost money. It's only ever gains. And again, you're an equity partner in the insurance company, so you're getting a share in their profits. What other way do you get to become an equity shareholder in a privately owned multi-billion-dollar company, right? Now, where we're talking about with this is saving. We're saying we want to save. Now, I firmly believe one of the reasons people don't save more money is they don't know where to put it, right? Think about this. Like what are my options if I want to save money right now? I can save in cash, right? Like, I can literally stick it like in a safe or bury it in the backyard or put it under the mattress. But the problem is that I know the news has been telling me the inflation rate is like 8-9%. So I already know when I save in cash, I'm losing value to inflation. So right off the bat, I'm like, I don't really want to save in cash. Okay. Now I can save in the bank. The problem is the average savings account right now is paying 0.03%. Not good. Okay. And so with that, we also have learned, if you've watched any of the news, okay, we've had, I believe, 3 or 4 banks that have gone under. Like, we have 3, I think 2 or 3 large ones in the US so far, just as a ripple effect. The first one was Silicon Valley Bank. Okay. We've got another one I forget the name of that had the same thing, where when a bank gets your deposits, they're loaning that money out. They're actually loaning that out. That's how people get money for a car loan. It's your deposits that are being loaned out to that person that's going to get the car loan, but you don't get the money from that interest. The bank keeps it. They're going to pay you the 0.3%. right? But they're not gonna share the profits with you. The insurance company that we're gonna work with on this shares the profits with you. Okay, but we've already seen this safe haven of a bank, okay, go under, right? Like if I just Google really quick, I'm gonna Google how many banks have gone out of business in the last 10 years. Okay, let's check. How many banks went out of business in the last 10 years? I think it's several hundred. Okay, so bank failures from 2001 to 2023. There were 563 bank failures from 2001 to 2023. Okay, so we just do the math on that. That's 22 years, right? So what's 563 divided by 22 years? Guys, that means every single year, 25 banks go under. Okay, that's routine. Like that's a lot. Okay, do you know how many of these mutual insurance companies go out of business? They don't. Remember I said they've been around for the last 170 years, right? So we don't have a good incentive. Why would I save money in a bank? Why would I take 40% of my income? Think about this. This is why people don't save. Why would I take 40% of my income, put it into a place that I know is putting my money at risk? 25 a year of them go out of business. They're putting my money at risk. They're not sharing any of the upside with me. When they make 19% interest on a credit card by loaning my deposits out to that guy who's now paying them 19%, they don't share the 19% with me. I get paid almost nothing. Right? So I don't have any incentive to save there. I'm not getting anything. There's no reward. There's no prize at the end of the game. And there's a really high chance I'm going to lose my money. And I'm being told this is the safest place I can put it. Okay. What about the retirement plan where I put it there and now it's in a mousetrap that I can't touch till I'm 60? I'm not incentivized to do that. Why would I want to give my money up for the next 3 decades of my life? That's not rewarding myself for saving. Like we're penalizing the upstat. An upstat is someone that's doing the right thing. Their statistics are up. When someone's saving more money, they should be rewarded, not penalized. So it's kind of a situation where it's like, shoot, if I save it with the banks, I'm not going to make anything at all. And they're going to risk it. If I put it with Wall Street, I can't touch it for the next 30 years. They're going to commit fraud with it, right? There's no win. Where's the win? Where do I get rewarded for doing the smart thing? So a lot of us are finally just like, I'm just not gonna. I would rather just have a car payment. At least I can drive a vehicle that I like right now. I would rather just go on the vacation. At least I can have a nice experience right now. Do you see how we're disincentivizing saving? And it's because you don't control the rules. This is why it's important to save in your own bank. Of course, when you save in someone else's bank, they're making money, not you, because the purpose of a bank is not what we think it is. The purpose of a bank is not to save money and keep it safe. The purpose of a bank is to make profit for the owners of the bank. That's the real purpose of a bank. The purpose of Wall Street is to make profit for the owners of the Wall Street funds, not for you. When we realize that, then getting into the banking game becomes different. If the purpose of a bank is to make profits for the owners of the bank, the first question I have is, how do I become an owner of my own bank? Right? So safest place to save, we're going to use life insurance to do that. The first thing is I still do need to deposit money somewhere, right? So when I deposit money with my life insurance policy, with my sacred account, it's guaranteed against loss. It's guaranteed to grow. It is not taxable. Just these 3 things alone make it worth it for me. Okay. There's no stock market volatility. There are no wealth management fees. Okay, it's protected from creditors. It's protected from lawsuits. I've got complete privacy over my fund. It's it's a unilateral contract, which means it's one way between me and the insurance company. Okay, this is the safest place I can save my money. Safer than the bank even, right? The money is not being loaned out. It's what I call allocated. So when an insurance company, you deposit into your own bank, they're not loaning it out to someone else for a car payment. It's actually there. They have to keep it there. It's their reserve requirement. Like that's there. It's being loaned out. It's actually in many states insured at a higher level than the FDIC is even. Right? So this is the money that when I put money here, it's the money that I never want to lose, that I always want to make money on. So think about it. When you earn income, what percentage of your income do you A, never want to lose, and B, always want to make money on forever? Okay, my answer is all of it. Like, why would I want any less? Like, if I could put all of it, I would. Okay, now the reality is I've got to spend money on life and things. I'm not going to be able to put all of it there, but I can put a lot of it. The more, the merrier, right? Okay, so here's how it works, right? This is just a little sketch. So I'm going to go ahead and just draw this out with you guys on the board. So if I have $1, I put $1 into my account. This dollar is going to grow at 3 to 5% per year, tax-free. And it's going to have all of the growth and protections that I've mentioned so far. And it's going to do this every year on average for the rest of my life. Think about this, for the rest of my life, not for a period of time, for the rest of my life, till I either die or turn 121 years old. It's going to do that, right? Which means in 10 years, my $1 will be worth $1.50. Okay. Now, while this is happening, while it's growing at 3 to 5%, while my dollar is turning into $1.50, I can borrow 70 to 90% of my dollar, which on the middle difference of this, it's about 80 cents. So I put in $1, my dollar grows at 3 to 5%. I can pull out 80 cents of that dollar, and the entire thing still grows at 3 to 5% like it never left. And the reason why is it didn't leave. I borrowed against it. Right? I borrow against it for two reasons. I don't want to get rid of an asset that's producing by selling it. So why would I pull money out and lose the 3 to 5% growth? The second reason is when I take a loan against an asset that's producing, I don't owe taxes. Okay, if I made money on an asset and I sell it, or I pull a distribution out, or I get rid of it, I now pay taxes on my gains. But if I borrow against it, the loans are not taxable. A loan is not a gain. It's not a form of income. Okay, now I do have a cost of borrowing, which is about 1 to 3% interest costs. Okay, now here's the thing is if I'm making 3 to 5 on average and it's costing me 1 to 3 on average, I'm actually making positive profit to borrow against my own funds. So I've got $1 in here growing at 3 to 5%. I'm costing, 1 to 3% to borrow. I'm making a positive spread here between this rate and this rate on the 80 cents. Well, the dollar still grows, and I'm taking this 80 cents I've borrowed, and I'm going to go do smart things with it. I'm going to go pay off debt, or I'm going to invest it, or I'm going to make large purchases. Instead of paying interest to a bank on a car, I'm going to pay it to myself, right? So let's say I invested in real estate and I'm making 8 to 12%. Okay. Now, if I took just this dollar, right, and I just invested in real estate, I would be making just 8 to 12%, right? If I took this dollar and I put it in a savings account that's making 3 to 5%, I would be just making 3 to 5%. I can't have both. With the sacred account, you can. Okay, the phrase I hated the most when I was a kid is you can't have your cake and eat it too. I was like, what's the point of cake? Like, why would you have cake and not eat the cake? That's the reason you have cake. Why would I have cake and not eat it too? It makes no sense. So when I saw the sacred account, that was ironically what I thought of. I was like, I can have my cake and eat it too. I can have the money here growing and also use it, and it's still growing while I use it. Little do we know, and some of you guys do because you're clients, this is what banks do. When you deposit money into a bank, the banker borrows against the deposit. He pays interest to borrow against the deposit. The interest is what he's paying to you. So you're the depositor, you're earning money on your account. The banker borrows against it, paying you that interest, but then he loans it out to someone else for a business loan or a mortgage or a car or whatever. Right? When he does that, he keeps the interest. Right? So this is the profit. So if you're the banker, you're the depositor putting the dollar into the account. You're also the banker borrowing against the deposit and paying interest. Then taking the money you've borrowed and loaning that out to the borrower. Now, in this case, you're also the borrower. You're the depositor, you're the banker, and you're the borrower. You're wearing all three of those hats, right? So you're using the money now to invest, to pay off debt, to do whatever you're going to do with it. You're making smart financial decisions, right? And then here's the ironic part, guys. When banks make profit, they have about 20% of their tier 1 reserves, which is their most prized reserves, the money that they're saving up for reserves, keeping themselves solvent. About 20% of this, guess where they put it? They put it in something called bank-owned life insurance. You can Google this. There are over 3,000 banks in the United States, on average, that keep about 20% of their tier 1 reserves in high early cash value dividend paying whole life insurance to the tune of over $200 billion. Think about that. Like, you're putting money into a system. Same. You're putting money into a system. Your money's being borrowed against. Same. Your money is being borrowed against. It's being loaned out to someone else for interest. Same thing. It's being loaned out to someone else for interest. Okay. The money is then coming back as profit, and the bank has a shareholder. The shareholder earns a dividend. Same. The insurance company has a shareholder, and the shareholder earns a dividend. Do you know what the difference is? When you do this with a bank, you're not the one making any of the money. The bank is, and the shareholder is, and the guy that's borrowing your money is making all the money. The only person that doesn't make money in a bank is the depositor, which is so crazy because none of it works without the depositor. The one guy they need is the one that they pay the smallest amount to, right? The banker makes the difference between what he pays on his deposits and what he's lending the money out for. The borrower makes the difference between what he's paying in interest to the bank versus the profit he can make on that loan. The shareholder is making money on the dividend. The depositor is making nothing. So the question isn't, should I have this? Should I do the sacred account? The question is, are you done letting them win? Are you done letting them win? Like, when are you going to get in the game? I'm showing you right now, you can do this. You can do that. It's already happening to your money. They're literally using the exact same tools. They're actually putting it in the same life insurance policy that I'm telling you about. Cut out the middleman, right? That's the one change. If you change this one thing in your life, that's it. The game is yours now. You can win because you actually are in control of your own banking system. So this is how this account works, right? And this is why you would want to put more money into it, right? So you might be looking at this and you're like, okay, well, that's cool. How come more people don't know about this? This is the number one question I get asked. It's not about how many people know about it. It's about which ones, right? So it's called the top 1% of wealth, which is a very small percentage, which means everyone's not doing it. Okay, there's two things with when people are doing a lot of, like, everyone's doing it, that whole thing. There's two things that I look at with that. The first one is, if everyone's doing it, it's probably not good for me. Okay, I've gotten the majority of my success because when I was 18 years old, someone told me, Jerry, if everyone's doing it, you probably shouldn't. And that made sense to me. Everyone invests in the stock market, so I don't. Okay, everyone owns a house, so I don't. Right? Like, these are when everyone does it, it's probably not a good idea. Okay, the other thing is too, it's not about the numbers. Like why doesn't everyone go to the gym? Why doesn't everyone donate money? Why doesn't everyone take vitamins? Just because it's a smart thing doesn't mean everyone's doing it. It means smart people do it. And if you're a smart person, you're going to see this and you're going to say, this makes sense. Now, it's not about how many do it, it's about who does it, right? So I just told you the largest banks in the US has over $200 billion in this type of life insurance. They are the #1 buyer and owner of this kind of life insurance. Above everyone else, Joe Biden owns 6 of them. Okay, J.C. Penney used the sacred account. Walt Disney used the sacred account to start Disneyland. Ray Kroc used it to start McDonald's. Foster Farms used it. Stanford University. John Rockefeller, Senator John McCain, the Pampered Chef, Waka Flocka Flame, if you know who that is. Like, we can go on and on and on with people who use this. Teddy Roosevelt used it, right? Like, it's not about how many, it's about who, right? Who uses it? When I was a personal trainer, one of the things that used to bother me so much was overweight personal trainers. Somebody that didn't have their own results yet because they had a certification, they could tell everyone else what they should do. And it's like, dude, you're not even using it yourself. Like, why are you teaching other people this? You're not even using it, right? So if I'm in a gym and there's, you know, everyone is following the advice of a personal trainer, but that personal trainer is overweight and everyone doesn't have good results. And then there's 1 or 2 people that are working with a really fit guy that might not have the same certifications, but they're in shape. Observing this, which one are you going to work with? Who are you going to want to go be a client of and get workouts from? The one that actually has results and the one whose clients are getting results. Regardless of what everyone does, you can see clearly that the results are coming from this person. I'm going to go work with them, right? So millions of Americans do know about this. The banks, they actually are disincentivized from teaching this to you. You have to realize we live in America. Like, we're very big on marketing. The 401k is something you do because you were marketed to do it. You have credit card debt because you were marketed to do it. Did you know before the 1940s and 50s, there was no such thing as credit cards? Now everything is on a credit card, right? That's marketing. Like, banks don't make money for you to use our system, the sacred account, instead of theirs. So they're not going to teach you to use it. Think about where do you get your financial education from? Banks. That's one of the first places. They teach you about loans and deposits. And you're like, okay, I want to go to the bank and get help with my finances. I'm going to set up an account. I'm going to get a car loan. I'm going to build my credit. I'm going to do whatever, right? So banks don't make money if you use a whole life insurance policy. Wall Street also does not make money when you use a whole life insurance policy, right? Why would I put money in my 401k to earn 3 to 5% per year, which is actually what the average retail investor made per year over the last 20 years, according to Dalbar, it's a mutual fund rating agency. which I can't even touch the money till I'm 60. When I could put it here and I can make 3 to 5% per year, tax-free, use it now, borrow against it, and still get the growth and have none of the criminality and craziness that happens on Wall Street. Okay, so Wall Street has no incentive for you to know about this. The other thing is every dollar you put in here, the IRS can never touch again. So the IRS has no incentive for you to know about this. If every single American saved 40% of their income in sacred accounts, Wall Street, the banks, and the IRS would fail. No one would pay income tax ever again. No one would ever need to go get a loan from a bank, and Wall Street wouldn't get a dime of our money. So think about, is there incentive for you to know about this? No, there's really not. Okay, the banks certainly don't want you to know that they're using this. You would use this product instead of their own. Right? It's like it's so good that they don't want you to know. They don't want you to know they're using it. They're not advertising it. They don't sell it to you, but they're the #1 buyer of it themselves. Right? So we kind of talked about what it does. I'm not going to jump into this part too much, but here's some examples of what can happen, right? So this is, kind of an average case. Bill and Sue, they deposit $1,000 a month into their account. In month 1, they can borrow $800 a month, their entire, or sorry, not $800 a month, $800. They put in 1,000, they can borrow 800. Their entire $1,000 is still growing. At the end of year 1, they've deposited $12,000. Okay, they can borrow $9,600, and their $12,000 is still growing like it never left. Right, so they borrow the $9,600. They pay off a credit card that has an 18% interest rate and had a minimum payment of $200 a month. They were scheduled to be in debt on this credit card for the next 84 months. Okay, so what they did is they borrowed from their policy, they paid off the credit card. Right now, they've now saved themselves 18% and a $200 a month payment. That's money they're keeping, right? So they pay themselves back with the $200 a month. They freed up from the credit card. It takes them 4.5 years to pay themselves back in full. So they're going to be making 18% by not paying it. They now have a $200 a month increase in their savings rate, and they're out of debt in 4.5 years. And the money they're paying on this debt, by the way, is to themselves, right? Rather than being in debt for 84 months to a bank. Okay, their $12,000, because it was growing this whole time, is now worth $14,362. They've got zero debt, and they're saving $200 a month, right? Remember when I told you that they had to pay some interest to borrow? So their interest over this period would have cost them $1,129 over 4.5 years. Realized they made 14,000 on the they had 12,000, which now cost them, or now turned into 14,000. The interest was 1,129, and they saved $6,000 in interest by not paying that 18% credit card rate. Had they not used this method, they would be in debt for 84 months. They'd pay $7,200 in interest, and they would have $0 saved at the end of 84 months. So what would you rather have? If you've got consumer debt, $0 saved, paying $7,200 in interest, right? Being in debt to a bank for the next 84 months, or zero debt, $200 a month increase in your savings rate. You've actually got $14,000 instead of $0, right? And you paid $1,100 in interest to a bank that you own, an insurance company you own, rather than to someone else. Okay, that's with debt. With investing, Ted deposits $100,000 into his sacred account as a lump sum. He puts it in as one chunk. He wants to invest that in real estate. Immediately, Ted can borrow $90,000 against what he deposited. So he borrows the 90 grand. He invests in a private real estate deal. He's now earning 12% interest for the next 5 years. Okay, 12% interest on 90,000 pays him $900 a month. He takes that $900 a month and he pays himself back. All the while, his 100,000 that he originally put in still grows at 3 to 5% tax-free. Okay, after 5 years, his 100,000 that he deposited has grown to 122,000. In addition to that, he earned $54,000 in interest from the investing. Okay, his cost of borrowing over the 5 years was $94.57, while he now has a net profit on his sacred account between that and the investment of 66 grand. Okay, had Ted not used this, he would have only made 60 grand. Meaning if he took his 100 grand and just put that in the real estate deal only and didn't use the sacred account, he would have lost out on almost $7,000 in extra profit. Right? So it's not, should I do this or not? It's what would you do with the extra $7,000? What if you did that more than once? What if you did that every year and you did that for the next 20, 30 years, like you're being taught with the retirement model? Okay. Another example, John and Mary built up 30,000 in their sacred account. They want to buy a car. They take a policy loan for 30 grand. The 30 grand they borrow against is still earning 3 to 5%. They take that 30 grand, they buy a car, and they avoid having a $500 a month payment. So instead, they pay themselves $500 a month because they've borrowed from their own bank. So they're going to pay their own bank back. In 5 years, their 30 grand has grown to 36,000. Their car, which they paid 30 grand for, did depreciate, but it's paid off and it's worth 15,000. Their cost of borrowing was 3152, but at the end of 5 years, when they're all done with this, they've got zero debt, a $15,000 car, and $36,000 and $630 in savings in their sacred account. Okay, had they not used the sacred account, they'd have paid $6,000 interest to the bank, have $0 saved, and a $15,000 car. Which one would you rather have? Right, guys, this is math. Like I said at the very beginning, right? So I'm not gonna go through the whole thing here, right? But I want to talk about, like, if this clicks with you and you're like, wow, that's amazing. How do you put money into this? Okay, how do you get access to more money to put into the system? We've only got a few minutes left, so I want you to pay attention closely. Okay, the very first one is any money that you're giving right now to the IRS, banks, or Wall Street, you should be redirecting to your sacred account. Okay, and here's what I mean by that. Let's say that you have money going into your 401k. Okay, I personally, for me, I don't put money in the 401k. So if I'm making $100,000 a year, that's my income. And my 401k is giving me a 3% match. Instead of putting money in and getting a 3% match, right, I'm going to take that 3%, which is $3,000, and that's going to be $250 a month, right? So instead, I'm going to put $250 a month in my sacred account. Okay, the other one here is my tax return. So if I'm getting, like an average American does, about $3 grand a year on my tax return, I'm going to adjust my W-4, which is the form that tells the IRS how much money to pull out of my paychecks. And I'm going to say, hey, I don't want a refund. I just want you to only take out what you need. So I'm going to get paychecks that are bigger now because I pay less on my tax withholdings. $3,000 a year that I overpay in taxes that I usually get a refund on is $250 a month. Okay, the other one here is bank savings, right? So let's say that I've got $10,000 saved up in a bank account right now. Okay, I've got $10,000 saved up, and I, on average, put in, $500 a month into my savings just to save for a rainy day. Okay, rather than letting it go in their bank, right, where they're going to loan against my deposit and do all the stuff we talked about today, I'm going to remove it from their system and I'm going to put it in my own bank. Okay, just on this, we've come up with a $10,000 initial deposit. And then we've got $1,000 a month going into my account. Okay, I found money for this now, right? Another one, let's say that I own a house, I'm going to sell it, I'm getting some equity from the sale. Rather than putting that lump sum in the bank, why not start a sacred account? Put it in a sacred account, right? If I have a business, rather than taking my profits and putting that in a deferred compensation plan, or, putting that in my 401k, or, spending that on vacations, I can put that in my sacred account. When you realize every dollar you spend, every dollar you save, every dollar you invest could have first gone through your own bank. You've already seen when you pay off debt, you just do it with regular cash, you put it through your own bank. You've already seen the difference now. Right? You buy a car, you just pay, regular with the bank, or you put it through your bank. You've seen the difference now. You invest in real estate, you buy it with cash, or you put it through your own bank first. You've seen the difference now. You could be making more money on every single thing you do in your life. So why not use the sacred account? Right? Like creativity follows commitment. So when I'm committed to my family's financial future and I'm like, hey, I want to actually build financial independence, I start getting creative with how I can get more money. Right? For me, when I learned about the system, I was so excited about it that I started looking for ways to earn more income. Okay, that's another one, right? If I now have a place to put money where I know it's going to build wealth for me, I know it's safe, I know it's going to protect me from volatility, taxes, fees, all these things that erode away at my money, and I know that I can build wealth with it, I'm going to be excited about my finances all of a sudden. I'm going to want to go earn more income. Right? You can also, you can take old retirement accounts. You can sometimes, use those for life insurance. Like, there's a lot of things you can do. So one of the things I want to challenge you to do today, whether you don't have a sacred account at all and you're looking at this for the first time, right? is if you're that person, schedule a call with Jules. Okay, schedule a call with Jules. Say, I want to set up my Sacred account. I want to learn how to become my own bank. Will you help me in that process? Okay, Jules will coach you through that. Okay, if you're already a client and you're like, yep, I already have this. Why don't you have another one is my question. Right? I was challenged on my thinking earlier this year. I met a guy named Brent. Brent has over 40 of these. That's right, over 40, like 40. Like he has over 40 Sacred accounts. And I'm sitting there thinking, okay, this is completely bigger than I thought it could get. And I use these things for everything, right? So one is cool, two of them is cool, three of them is cool. It's not 40 yet. What do I need to do to get to that level? Right? So we're going to help you with that too. So if you have one already, I want you to get with Jules and I want you to talk with her about how do I open up another one? Okay, how do I start my second, third, fourth, fifth? And think about it. Like, how many Wells Fargo banks do you see in a town that you live in? How many Bank of Americas do you see in the city that you live in? How many JP Morgan Chases do you see in the city that you live in? They're all over the place, right? They're all over the place. And so that's because they understand that that's how you scale and you build wealth. So just like that, you should have your own bank on every corner of your life, right? I have dozens of these. I open them. I want to continue opening them. That's my plan. And that's my personal strategy. I'm looking at how quickly can I start my next one? Okay, I've got the ones I've got. Good. How quickly can I start the next one? Right? How can I make sure that my employees have one? How can I make sure if I'm married, my wife has one? If I've got kids, how do I make sure they have one? I want everyone that I care about to be their own bank. Right? Because that's how we turn the tides on this. This is how you build wealth. This is how you create a generational change. And here's the great thing about this. Let's say that only half of what I said was true. And all you got was a death benefit. That means that if they did nothing for the rest of their life and you did nothing for the rest of your life, at the very least, you've still built generational wealth because it's whole life insurance and someone is going to get a tax-free death benefit no matter what. Okay, that's called securing the odds. That's literally like the best way to win a game is to cheat. That's cheating. Like I've already secured the odds. I already know if I don't hit my goal of building generational wealth for my family and the ones I care about, it's going to happen anyways because of the death benefit. So I'm going to do everything in my power to get there. I'm going to learn. I'm going to reduce my taxes. I'm going to earn more income. I'm going to invest. I'm going to do everything I possibly can. And I think I'm going to get there. And if somehow I don't, it's going to happen anyways. Okay, that's called securing the odds. So guys, what I want to do is open this up for a couple of questions here before we wrap things up. One more time on the book. Okay, if you did not get a copy of the book yet, okay, I want you to go to jerryfetta.com/B2F promo. Okay, and I want you to get a free copy of the book, Blueprint to Financial Freedom. Okay, the Sacred account is a tool. Just like when you build a house, a hammer is a tool. Okay, a tool is cool, it's awesome, but if you don't have a blueprint and you don't have a team and you don't have the rest of the materials, it's not going to help you. And if you're doing things in the wrong sequence, it doesn't matter how good of a hammer you used. If you put the windows in before you built the foundation, the hammer can't save you, right? So this is one single tool, one of the things we're going to use to help you achieve greater financial freedom in your life. The rest of it's in the book, and that implementation of what you're learning in the book is going to be done on a one-on-one call with Jules. Okay, so I want to open this up for some questions. I'm going to check our chat. I can't hang out too long for questions, unfortunately, just because I've got a couple calls coming up today. Good to see everyone, though. All right, just shouting out to a couple of people. Serena, it looks like Jules sent you a message. If you're still on, Serena, be sure you check your chat. Set up a one-on-one call with Jules. Same thing with Robert Shearer. It looks like Jules sent you a message, Robert. Be sure you check your chat there. Reggie, same thing. If you check your chat, Reggie, you got a message from Jules. Matt Eddy as well. Good to see you on here. All right, Nick has a question. If I'm in phase 0 working towards phase 1 when we're repaying my my loan back to my Sacred account, are lump sums better than repaying over time? Okay, so that's 2 questions. Good. So Nick is saying he borrowed against his Sacred account. He's got an outstanding loan. If he's got a lump sum, should he be paying back as a lump sum? Or let's say he used that loan that he took on the account to pay off his debt, and that's going to give him the $200 a month back. should he just do that? So here's what I would do, Nick. Whenever I take a loan, the thing I use the loan for should fully service the loan. And I let that play out. Any new money that I have, I'm putting into my sacred account as a contribution, right? So that means either I'm doing paid up additions on my current sacred account, unscheduled, dumping the money in, on a one-off basis, or I'm using that as a lump sum to start another one. Also, if my sacred account reached the MEC limit, does adding interest payments to the loan payment have an adverse effect on my sacred account? So Nick, kind of going back to what I said, so you can do, loan repayment. I wouldn't accelerate it. Instead, if you've maxed out the first one, I would say, let's open up the next one now, especially if you've got more income still. So the sooner, the better on opening that second one and continuing to scale and build that out. All right, let me check for any other questions here. Lauren says my sacred account is almost set. That's awesome. I love hearing that. Awesome. It looks like Maya booked an appointment with Julia. That's awesome. Serena asked, sorry, I may have missed this. How long did it take for the 12K to turn into 4K? That was over 4.5 years, I believe. Yeah, Ali answered. I believe that was over the 4.5 years. Good. That's all the questions I see there. Let me check on Facebook, just see if we have any questions in the Facebook chat. Awesome. I don't see any questions, guys. So one more time, if Julia sent you a message today, be sure you reach out to her. It looks like we do have Brianna Shaw on the call now too. Brianna is our other endorsed wealth mentor as well. So if you're working with Brianna, that's also fine. But again, check your chat, get set up with Jules. And again, question just came in. I'll answer this question from Reggie in a second. Again, this stuff is already happening with your account. So realize if you're watching this, you've got one of two decisions. It's already happening. So you can either profit from it by owning and controlling the system, or you can continue letting the banks do it. And the banks have been doing it for hundreds and hundreds of years, right? So they're very good at the game. And if you let them, they're not going to stop themselves. They're not going to bow out and say, oh, sorry, we're going to stop now. They're going to keep doing it. So you've got to look at this and say, am I doing this for my benefit or for someone else's? Right? If I'm doing this for my benefit, then I need to continue with my own sacred account. I need to set up another one. And if I don't have one, I need to set that one up to get started, right? These are all the things that you should be considering today. So I'm going to wrap things up here. I do see one question that came in from Reggie. Reggie says, I registered an LLC in my state. Is there any way I can register my sacred account through my LLC? So Reggie, that you don't really need to. The sacred account is already a protected asset. So you can definitely get with Hive Law, our legal team, and talk more about that. But the purpose of an LLC is to legally protect an asset. The sacred account already has that. If you've got business income through that LLC, that's really where you would use the LLC. As the sacred account is going to pump out, the business is going to pump out income. We're going to set up a sacred account in the name of that business, and it's a way for you to get another account opened. So that's the answer on that question. Good, guys. So I'm going to go ahead and sign out. I will leave Julia and Bree here in charge of the meeting room. So if you guys want to stay in, if you want to network, set up an appointment still, I don't want to close the meeting out just yet. So I'll leave that open. But thank you all for watching. Make sure that you do like, share, follow. Be back again next week, 1 p.m. Invite a friend. And then the last thing really quickly is we are expanding, okay? So I'm looking for more people who love what Wealth Dynamics does. You're an active client with a sacred account. You're winning. You love what we do, and you want to share this with other people. And if you want to share this with other people, I would like to teach you how to do this business, right? So we're looking for in North America, Canada, United States, Canada, and Puerto Rico, those that would like to join us in business. So if you'd like to do that, let me know, let Julia know, and we'd love to help you out with that. Otherwise, thanks for watching. I'll see you guys all next week.